I mean, the first thing is the volumes the volumes presage volatility, right? And these volumes have been extremely high. And I think in terms of market direction, I'll take that as a second part of my answer. In terms of market behavior and market structure functioning, I think you're going to continue to have high volume days around critical market perceptions. I think as you see people getting much more comfortable in understanding the range of risk that the virus presents, because that's the existential event that's driving people to become less certain, and certainty is correlated to comfort and fear. You'll have days where you're going to see the market move more than 1,000 points or upwards of 5 to 6% price range in a day. In terms of where the market goes from here, I'm in the camp that completely believes when you combine leadership with the mechanisms of the economy that are sound, and the economy is sound. People are not talking about the labor statistics. And yes, the rate of change can change, but these are sound, robust, economic, market reflecting activities. I am of the opinion that the marketplace is just one big opportunity right now. Again, the sectors, that remains for the professional financial advisor. From my perspective, there are structural changes in the economy that are going to provide for long-term growth in more than one industry and more than one company particularly.
So you think the stock market is attractive here? Is that where?
Yeah, I do. I do. I think that people, professional investors, were sitting on top of a market that was sitting near all-time highs. I think we had a triggering event, and it's going to continue because the event is existential. And by that I mean it's going to affect more than one part of our society dynamic. But it was sitting at all-time highs. Markets always look for reasons to correct. We are one standard deviation off that high at this level. Mm-hmm. The marketplace will smoothen in terms of people's anxiety. What do I mean by that? These buys are attractive to fundamental long-term investors, be it a year from now, 2 years from now. The natural buyers and sellers, people that are compelled to cross the market to buy and sell, to exit or enter a position, they're coming together in a concentrated period of time. So what normally might have taken a period of 3 to 4 or 5 months of correction until people start to understand the economic fundamentals are sound, it's taken a very short time. I'm a scale down. I've been buying, and I'm going to continue to scale down. Last December, right, the December of 18, I think the marketplace was maybe 7 to 10% off of where it is now. I'm recalling that. I haven't updated my charts because I just haven't been lazy. But I don't think I think we're in very, very sound buying territory.
Okay.
That does not mean it's not going to be a bumpy ride.
Let me ask you this. Let me ask you to put your oil trader hat back on, because that truly was your early wheelhouse, and I'm sure you have.
Different story there.
Yeah,
different story there.
So, I mean, this is an unbelievable day we're seeing.
So you have an a very inefficient placement of capital within the domestic oil-producing sector. You had a lot of lazy capital chasing very sophisticated opportunities in our oil patch. You see today that Saudi Arabia and Russia could not come to an agreement on production cuts. You will see the marketplace push itself to the level where the balance between supply and demand equal, and you will see a retracement of domestic production. Now, I'll be very interested to see if, in fact, we become net importers again. I don't think we will, but my point is oil has to test that $35 area again.
That's going
really
to be
non-inflation adjusted. You're really talking about the $28 to $32 a barrel range, and unfortunately, the oil patch, the exploration and production patch is going to go through a dislocation, and you're going to see a lot of bankruptcies and replacement and quite frankly, restructuring of the domestic oil market.
Wow, that's a big call.
Yeah.
Let me ask you this: rates dropping like a stone. I don't know what the best word to put on at this point. You had a 10-year go to 69 basis points, 66 basis points today. They've come up a little bit, but where do you see the 10-year going?
I am of the opinion that the market is irrational now in its pricing of debt. And I think that we need to have solid leadership around stable capital deployment from starting with the Federal Reserve. I don't think that the rate reduction was necessary at this time. And I think rates, unfortunately, I'm going to say this, I think there's enormous pressure to bring the rates down closer to zero than 1%. And I don't know if I agree with that, because I see real fundamental growth in the economy around creativity, around fundamental economic activity. It's very sound.
So it's interesting thought, Vinny, because if you think rates are going to continue to go lower, and you think that oil is going to go even lower, maybe in the 20s perhaps.
Yeah.
It's hard for some to see how that can translate into a higher stock market, which you think is attractive, even in light of those sorts of predictions on rates and oil.
I think there are companies in the stock market and activities that define the business of those companies that will grow in those conditions of easy money, access to capital, and lower energy costs. I do think that this notion of social distancing is quite frankly a very frightening concept. I think people have to understand how this virus, in fact, does travel and study as much as they can about it and make rational decisions around gathering with other people and conducting life.
Well,
that's an unsustainable set of conditions.